Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending Feb 4, 2022. I'm Preston Brent. Thanks for tuning in. Well, as you can see on here, bang, bang, FANG. Depending on which FANG stock you own, you either had a happy week or a not so happy week. Let's take a look at where we've been this past week, just kind of see what we got on tap here and what the charts are starting to look like. So if we take a look at the index performance, what I want to do is let's just get in here and get through this past week here. You can see everybody in the U.S. anyway was in the green. Okay, everybody in the green. So the year to date, we're still in the red. Best performing sector for the week is also the best performing sector year to date. That's energy. Worst is communication services for the week. Real estate, not so good year to date. And if we look at the PE ratio, you can see the current forward 12-month PE is just slightly, let's call it around 20. Dividend yield is 1.38, Treasury 1.93. So we got a really wider spread this week than last week, about 55 basis points. Earnings yield is a little over 4.5% for the S&P. So that's still well over the Treasury yield, pretty good little bit, right? Current VIX, well, it's down about 16% for the week. It closed the week at 23.22. So we're still up for the week, but down just a little bit. But energy or the volatility is staying bid. All right, we've got some issues with the markets. If we look at the equity markets, I mean, it was a very busy week as far as earnings go. Over 112 companies come in for earnings this past week. And like I said on this bang, bang, FANG weekly theme, Facebook's numbers were horrible. I think at one point their share price was down over 26%. It's like the largest the largest down move for a mega cap we've seen ever. Really amazing. While both Google and Amazon came in very strong, but the end result, because the cap weighting, it tends to move the S&P a tremendous amount. Nasdaq as well. Nasdaq Futures was crazy, right? Because the FANGs account for about a little over 44% of the Nasdaq Futures weighting. So Nasdaq Futures this week was all over the place. Okay, even though we managed to finish, as you can see here, in the green for the week of 2.38, almost 2.4% for the week. Still in the red for the year because it's just had a horrible January. And energy, as I said, is still outperforming. Okay, oil is over $90 a barrel, is no doubt going to affect the inflationary environment going forward. We also had a very heavy economic calendar for this past week as well. We did see factory activity move up a little bit, services falling back a little bit, but the big surprise for the week was the Friday payroll data. It set it up with ADP's private sector employment numbers on Wednesday falling 301,000 in January. So everybody was expecting Friday's monthly January number to just be ugly, ugly. And it came in at a huge gain of 467,000. Now that really spooked the markets. In fact, after the initial report, interest rates jacked up really fast and the market sold off on that interest rate move. But then eventually throughout the day, the market started to come back again. But I do believe these numbers reflect a lot of ongoing COVID adjustments. So over the next 3 or 4 months, job numbers are going to come in lower as they take some of these seasonal adjustments out of that huge January number. Okay, so that's one thing that I think is going to kind of mess with people a little bit. And like I said, that jobs data pushed the yield on the 10-year benchmark U.S. Treasury to 1.93%. Really, just a huge number. It's the highest number we've seen since the pre-pandemic. All right. In fact, it was the highest since late 2019. So that came in really amazing. Now, the other thing is across Europe, equities kind of pull back. Let me just get the European numbers up there for you guys so that you can see. In Europe, it was mostly down. The FTSE was the only one that managed to finish up 67 basis points, but the Euro stocks, 50 largest companies across Europe, the CAC 40, which is the French index, and the DAX, which is the German index. They're all in the red for the week and still red for the year. The FTSE is the only holdout, right? So their ECB president, Christine Queen Bee Lagarde, she made comments that seemed to leave the door open for more rate hike, possible rate hike increases this year. And what makes that, all the more surprising is most of the market was anticipating the Feds were going to be the ones hiking the rates mostly this year, the U.S. Fed, and expecting the ECB to hold off another year, but Queen Bee came out and said that she's left the door open for that. So that tends to put a little bit of downward pressure on the markets there. And they had the ECB, they decided to leave their deposit rate at a record low negative 50 basis points. So it's been stuck in that range. And they're also saying they're going to continue to reduce their asset purchases this year, much like the US Feds are due to end their asset purchases this March. Okay. So the other thing that I'm watching this past week, the Eurozone inflation ticked up to a new record, like it is here. It was at 5.1% in January. Meanwhile, further west, the Bank of England raised their key interest rate, which again that was caught the markets by surprise. It was a 5-4 vote. They increased their rate by 25 basis points. Now it's set at 50 basis points higher. Okay, so that and if you look at the index and you look at the markets, this FTSE is the only one in the green for the year. So they've gotten the early start as a large country starting to hike the rates. We don't expect ours till March. There's a big question in the markets right now. There's about a 36% chance, according to the Fed Fund Futures here in the U.S., that the rate hike in March is going to be 50 basis points. I don't think it's going to be that. I think it's going to be 25 basis points, but that's almost according to the Fed Fund Futures here, if you look at the data, then it's almost assured, as much as you can be for something that hadn't happened yet, that it's going to be at least 25 basis points. Okay. But meanwhile, back over at the Bank of England, they hiked their rates, so they're now sitting at 50 basis points. So they're ahead of us. We did see the Eurozone economy last year grew about 5.2%. And that is from a 2020 slump of 6.4%. Right. And looking at data from Eurostat, the jobless rate fell to 7% in the Eurozone for the final month of 2021. All right. So they still have a higher unemployment rate than we do here. Now, if we shift gears and move over to the Asian markets, Japan, you can see, was in the green for the week, still year to date in the red. Okay. And China and Hang Seng, Hong Kong, they're 0% because they're still on holidays for their Lunar New Year. Hang on 1 minute, guys. I got to get a sip of water here. So I'm going to mute you for just a second. All right, I'm back with you guys again. So sorry about that. But we can see here that Chinese markets or the Japanese markets, they're still, while most central banks are looking at cutting or raising rates this year, and Bank of England's already kicked it off, and we expect the U.S. Feds to kick it off in March for us here. But over in Japan, they're still cutting, or they're still providing a lot of stimulus. So that is supporting the Japanese market to some extent. And as I said, excuse me, the Chinese markets are closed for Lunar New Year all week, right? I mean, I wish we had holidays like that, but we did see their PMI data decline to 50.1 from 50.3. So their economy is very weak. Okay. Very, very weak. Their manufacturing, a public service, which measures their PMI, came in at 49.1. So the government entity reported 50.3, and the public service that measures this reported 49. I tend to believe, I bet it's even weaker than that. But that's the lowest level we've seen in China since February 2020, pre-pandemic. All right. So just not good data. Now, if I'm going to shift over and take you over to the charts, and I'm going to show you a couple of key things here that are a little bit troublesome that I see, even given the hike that we've had in price action this past week. I'm going to take you over. And as always, we're going to start with the E-mini S&P 500 futures. We'll take a look at that first. And what you're going to see here on this thing is that takes a couple of seconds here to come up on the screen, so you guys should be seeing it right now. Looking at the chart, the key number that I want you to focus on, or the key resistance, is the red line. That's the 50 EMA. Notice it's got a downward vector. It started to flatten as we bounced off these lows. Now remember, we were down 12.4% in the E-mini S&P 500 futures, right? And our low point was made back over here on the 24th of January, because it was one of the worst starts to the year we've had in decades. Okay, this is pretty much the month of January right here, just going straight down. Now, you can see here we moved up, we tested the 50 EMA, and then we roll right back over. You can see the 200 EMA is sitting right at around 4,400. We're in this really strong resistance zone right now. And if I just kind of zoom it out a little bit on the chart, you can see here this resistance zone was a resistance right here, and it became support right here several times over 5 or 6 trading days over here, and almost a week or so over here back in August of 2021. But now we're having a hard time getting over it, and the 50 EMA is sitting just slightly above it. Okay, so what does this mean? Well, I'm looking at this, and you can see the Elliott wave count of this impulse move right here, which would suggest that we can go lower. Okay, it would suggest we can move and actually take out these 42.12 lows that were made in late January. I've got to watch this to see how price action moves. If we look at our trading volume, I've got a purple line and a blue line. The purple line is a week's worth of trading data, and the blue line is a month worth of trading data. So basically a 5 EMA over a 20-day EMA, right? And you can just see here that as we came down, the purple line moved higher, and it was supported by heavy volume. The minute we got this bounce here moving up, you can see it just fell right off the table. And now the purple line's below the blue line. So what this basically means is this bounce off this low here is supported by less volume. Now that in and of itself does not mean that we're not going to go higher near term, but it's not a good sign. And the other not a good sign that I just brought to your attention was the 50 EMA, right? Typically in a bear market, and we're officially not in a bear market, all right? That takes a 20% move lower. But typically what is a very, very common pattern and a great way to trade a bear market is you generally go below the 200 and the 50 EMA, and then price action always comes up in a bear market, in a bull trap or a counter-cyclical move, and test the 200 EMA and or the 50 EMA. And then during that test is the time to add more shorts, and then it rolls over. So this is a classic pattern right here in a weak market. Now, we're going to get inflationary data next week. In fact, I think it comes on Thursday when we get the CPI. And I promise you the markets are going to be moving around a lot when we get that CPI number, because the markets are now focused very closely, as the US Fed is, on where is inflation. And if inflation shows it's not abating, then the odds are going to go higher than 34, 35% that we're going to have a 50 basis point rate hike in March, right? And that's going to push the markets lower. So we're going to watch this very closely. Now, let me show you the Nasdaq 100 futures. If you look at the Nasdaq 100 futures, we could not even hold the 200 EMA. We held it one day and we gave it up. Remember, when you take out a key support or resistance point, you want to see follow through in that move. So in this case, it was key resistance. We took it out. We had no follow through. And if we look at the trading volume, the exact same thing happened here too. This bounce up is on a lot lower volume. In and of itself, it does not mean as much, but supported by not even being able to clear and hold the 200 EMA, it's not good. And now the Nasdaq 100 futures is down 18.25%, right? That's close to bear market territory. Now keep in mind the Nasdaq 100 futures is just that. It's 100 of the largest Nasdaq uh, uh, stocks, of which the FAANGs, which is why I said our week theme is bang, bang, FAANG, controls about 44% of the entire Nasdaq 100 futures. So in a way, it's a little bit misleading. You got to bounce it out to the Nasdaq Composite, which is all companies in Nasdaq. And looking at all companies in Nasdaq, they fell even harder. Notice the 2022 low was down almost bear market territory, 19.2%. Again, we did not even take out and challenge the 200 EMA, and you can see the 50 EMA is moving very hard down to what we call a death cross, which is when the 50 crosses the 200 to the downside. Folks, NASDAQ has got more downside to go from what I'm seeing on these charts here. Any rally, in my mind, right now is a bull trap. The markets are pricing in higher interest rates, which affect tech companies. A lot of these mega cap tech, like Apple, Microsoft, or Amazon, or some of these others, especially Apple and Microsoft, have strong balance sheets, a lot of cash. So those will go down, but they will go down less than others. So example, if I were to just show you Apple here, right? If we take a look at Apple, you can see here that the all-time highs in Apple, is a little bit of a bleed through here, is right around 182. And just to show you how far down that it went. Intraday, it was down in bear market territory. It fell intraday. I'm sorry, not bear market territory. The point was a lot, but let's look at it again. Let me get it. I was off the screen here. So it was down 15.46%. So NASDAQ was down a little over 19.2. NASDAQ 100 futures down about 18 and some change. Apple was down 15.4. So understand that even though they're going to fall less, they're still going to go down. Apple right now on Friday's close is down about, maybe 5.5, 5.6%. Not as bad. But if we come down and challenge those lows again, Apple will be an opportunity for you to pick up and buy longer term. Same thing with Microsoft. Same thing with Google. Same thing with Amazon. If we look at the FAANG Index, this is a customized index I made that includes Microsoft, Facebook, Apple, Netflix, Google, and Amazon. You can see here this FAANG Index came down 24%. So we're in bear market territory. We moved up and we closed right on the 200 EMA and we're back down again. Every stock that I see, even some of the mega cap, are weak based on where we're sitting right now. And all this is a change in regime from free money at 0% to higher interest rates, right? And they're just revaluing the market, as I said, with the PE ratios. Right? I mean, if you've got the forward PE is now, 20 or in the high teens, when just going into January this year is over 21 and a half, right? Almost 22. So we're getting a slow revaluation due to the higher rates. Okay. So that's where we're going. Now, the other question is for our members tomorrow night. I'll go through some stocks that I really like and why there are certain sectors that are going to be favorable this year over others in a rising interest rate environment. Okay, so that's just one of the things that I'm seeing here. Now, if we look at the Dow, all right, and because the Dow has been less affected than others, okay, and let me just find the Dow on here. Where are we? Let's see. Where did it go? Well, let's look at the. Here we go, right down here. The Dow closed Friday down just a little bit, but if you look at the Dow, same thing. We attempted to regain the 50 EMA, held it one day, but no follow through, and away we go again, right? The Dow was only is official in correction. All of them were in official correction territory. But the Russell futures was actually in a bear market, all right? Now, this was down 21.7%. Right now, we're down 9 in bear market. But again, look, we've already had the cross in the 50 and the 200. Now, all indexes tend to go together. You're going to have an outperformance, and that outperformance could last for 4 years, 5 years, even a decade, right? Where you got Nasdaq leading the way, or you got the Dow, or you got the Russell. And different times within a given year, you'll have a leadership shift depending on where the market environment is. Typically, the Russell, which is mostly small cap, typically leads the way coming out of a bear market, but it also leads the way down coming out of a bull market, right? And the rut is down a lot right now, okay? In fact, if I were to just kind of see where we closed, let me just get this off here because we got to start with the all-time high, which is way up here. The all-time high in the rut was made on November 8th, 2021, right? So we're still in this move here, a long-term, we're down about 18.8% roughly. So remember, bull markets come to an end fairly slowly, and it can take a year or two for the top and the peaking pattern and has a highs been made before we go into a bear market. Bear markets tend to end abruptly, sharply, with a sell-off and a V bottom and then a test of the V, and then boom, we're done. Bull markets are a lot different, the environment of a bull market. And the reason why is typically investors don't want to give up. You got the buy the dip crowd always coming in, going, oh, we still got to go higher, right? And you've got money still chasing, and it tends to hold the bull market up longer than it should. And then finally it gives it up, it capitulates, and we roll over, and then people just give up and get out. So we've got to watch these dynamics very closely. Now, UPS had great earnings, right? If we look at UPS, which is kind of a view of where the transport industry is, you can see we gapped up and made new all-time highs, right? If I just really shake it out here and put a little bit of a resistance level on the screen, you can see here we broke out. We're at new, we're probably going to come back and retest that, almost guaranteed, right? But you can see that breakout. Now they're in the transport, so that means FedEx is going to, it kind of brings everybody else with it. So if we look at the industry here, the transport industry, right? So if we look at the transports, you can see this is nowhere near. In fact, we can't hold the 50 EMA as well. The 200 held here. You can see where the 200 provided resistance here. This is the Dow Jones Transport sector ETF for all transports, right? It is showing a lot of chop and weakness. So guys, we got to follow this very, very closely here, okay? I mean, this is something that has got me a little bit concerned here that we couldn't get over and hold those 50 EMAs, right? And of course, if we look at the VIX, it's going to be elevated all year long. Get used to it. You can see we're still in a down fast market. We actually moved up here into market correction territory in this range of the VIX here from 30 close to the 50 area. We're nowhere near the black swan, but you could see we went right up into the middle of the markets in correction territory. Now we're just in a down fast market. We're still over the choppy market area. So this VIX range here is typically associated with choppy markets. This VIX range here suggests more downside. And for our members, we'll spend more time looking at interest rates and the VIX and the vol term structure, just to get an idea of just how fearful these markets are or could change overnight. We got to watch this very closely. And of course, if we look at treasuries, on Friday, interest rates went up hard. You can see here we made new 2022 lows. I got to adjust it here. We came down, and I had hoped that we would actually climb up higher. We got some plays here I've recommended for our members in the interest rate and the bond market. And this was down over one full handle in 12 ticks. So that was a big move down. And if we look at what it looked like on the 10-year interest rates, well, guess what? We closed at 193. We blew right through my 2022 high, came right up here, and we closed at the upper boundary of my target range. My target range was really designed to hit from early January, is a wide range, to in April. And we've already hit it earlier because the markets tend to move faster, quicker than you expect. But we've hit this range. And if we get over 2%, I think you're going to see an adverse reaction in the markets, okay, or in the equity markets. But that's kind of what we're going to be watching very closely. And then if you look at the HYG, which is the high yield, notice here the high yield, which is another word for junk, right? We're just continuing to go down. Now, this tends to go in a correlation with the SPX. This is clearly underperforming the SPX. They tend to go together. So this could suggest that we can expect more downside in the SPX. We got to watch this very closely. And members, again, we will go through this on Sunday evening. And of course, if we look at currencies, you can see here the US dollar has given it up. We're back in the red again. I had suggested up here that I'm more bullish the euro than I am the dollar. So going long euro dollar to me makes sense, right? And I think I mentioned that to you guys here in our free weekly roundup, right? And here is the euro right here. We're challenging 2022 highs. I think we're going to come up and challenge this area here. Unfortunately, as the airlines open up and more international travel, by the time I'm ready to go over to Europe and do my seminars in Europe, I used to do them every summer. I haven't done them since 2019 because of COVID and early 2020. The euro is going to be more expensive to the dollar, right? I wanted to go when the euro is relatively cheap, but timing and luck, I guess. But you can see here where we are. I still favor the euro to the upside on the dollar. And then, of course, if we come down here and look at gold, gold in my mind is just a ticket to nowhere short term, right? We've given it back up. We're kind of in this upsloping trend here, but to me, I'm not doing anything in gold or silver at this time. Same thing with copper, very choppy, just a choppy trip to nowhere. Can't trade it. I'm not in that right now. I'm not even interested in it. Oil, well, neutral to bullish is where we are. I said oil would go to the low 90s. Sure enough, I hadn't even had a chance to adjust it. It's moved so quick. It actually hit 93.17 on Friday, and then it pulled back. Right. So if it does pull back, the pullback zone is going to be in the mid 80s. We could, and when oil gets this close to $100 a barrel, well, it's going to test and check $100 just because it can, right? So you want to lean neutral to bullish here on that. Now, there are trades we'll look at in our weekly roundup or our weekly market watch tomorrow evening for our oil traders. But this is, I like oil, right? And I've also liked all year in the last 6 months of last year, oil companies. So this is kind of where you want to be, right? In the oil patch. I think it's a good one to be in. And hard assets too, right? For inflation is higher, interest rates going up, hard assets can work. But members, we'll go through more detail where you want to be and some really interesting plays that you can take. Also in the ag, be careful with ag, just as a quick FYI. If we look at corn as an example, you can see this move in corn. A lot of this is resulting from the Russian influence on the Ukraine at the border, because Russia and Ukraine are big exporters of corn, wheat, soybeans. And if you look at it, when they have issues, these things go through the roof. When their issues stop, they start to come down again. So just be careful if you're trying to chase momentum in some of these, because they could reverse quickly. And in many respects, so is energy. But in the energy market, there are other factors hitting on oil besides Russia, Ukraine. Okay. I personally do not believe Russia is going to go into Ukraine. Too big of a price to pay, but it's enough. It's enough to put a $2.5 to $3 premium on the price of oil right now because of that. Right. So this is kind of where we're sitting. on the markets right now. Members, I will see you tomorrow evening for our weekly market watch. If you're not a member, I highly encourage you to come in. We're adding members all the time. We kind of trade everything from options on equities to stocks to options on futures and commodities. And there's going to be some great plays this year in 2022, much like there were in 2021. All right, everybody, have a great weekend. Members, I will see you tomorrow evening for our weekly market watch. Take care, everybody. Ciao now.